Well, hello again, everyone, and welcome to our latest video report. Dion Zukiwsky, branch manager and portfolio manager with you here again. And with the holiday season around the corner, in today's message, we're not going to focus so much on Christmas's silver bells, but instead something we call silver linings. What is happening in the markets, how it relates to silver linings as it comes to performance in 2023, plus some silver lining tax planning that we'll look to provide for you as this year comes to a close. We're also bringing back Zukiwsky Group associate Rachel with a quick Did You Know segment as well. So by now we know that even though 2021 was a strong year for investors, this past one has been tougher, to put it mildly. A combination of persistently high inflation, causing a rapid rise in interest rates, along with geopolitical issues in Europe and China, has all made for a challenging investing climate. Although there has been an upswing in markets during most of October and November, we feel there could still be some volatility coming in the near term. Don't get me wrong, seeing those investment prices improve is certainly a positive thing, but the cycle isn't quite ready for its next longer-term upswing. So the magic question is, Dion, if this is a shorter-term rally, when can we expect better and longer-lasting market performance? Our strategists believe that this mainly has to do with when interest rates and their hikes will slow down or moderate. Now, there has been one nice silver lining with these higher interest rates, and that has to do with fixed income. We've been able to buy new bonds and fixed income ideas for portfolios at higher rates, many in that 5 to 6% range, even approaching 7% now. However, for equity or stock markets to resume their leadership, this interest rate cycle will need to change from continuing to move up at these very high levels. It's predicted that central banks in Canada and the US will hike again by about half a percentage point in December, then moderate to a quarter or 25 basis points in February, with a final one in March of next year. We see further from the chart here. From our teams at Scotia, this shows the US Federal Reserve's predicted interest rate hikes, which is very similar to Canada. The main point is that markets have priced this in towards March of 2023. Now, of course, this is not a guarantee, and is based on economic conditions such as inflation coming down, which could happen sooner or later than this time frame. However, it is giving us another silver lining knowing that there is light at the end of the tunnel, as equity markets typically begin their upward growth cycle again when these interest rates moderate and potentially slow down. And it does appear that these interest rate moves are having the desired effect. We live in a bit of a bizarro investing world right now, and it's being cheered if the economy slows down, which is opposite to normal thinking. We're going to show you a quick visual on US inflation. Looking at the chart here, we're measuring what's called Consumer Price Index, which is basically a measure of inflation. And we can see that coming out of COVID in 2020, there was a big spike in the cost of goods. Now, that spike has started to come down as interest rates have come up. In other words, the economy is slowing down, which is a positive, but not quite at the desired levels quite yet. So from a strategy perspective, even though we're starting to see these silver linings, markets will be choppy for the time being. Each time interest rates move higher, there's going to be talk of recession again, the mighty R word. As I mentioned in a previous video, this is not something to be afraid of. And even if a mild recession does occur, markets tend to move higher during a recession while it's already happening. For now, we're going to remain defensive and focus on proper positioning towards 2023. And speaking of positioning, annually our team reviews what is called tax loss harvesting. This is another silver lining approach where in non-registered investment accounts, in other words, not RSPs or tax-free savings accounts, it may be beneficial to clean up, in other words, sell certain investments which can help you with your tax planning. These specific sells can then create what's called a capital loss. From there, a capital loss can be used against any capital gain, and you can take that back 3 years or carry it forward to future tax years. To qualify, the same investment requires a waiting period of 30 days before it can be repurchased if you desire to do so. We will be reviewing accounts to see where this may be helpful, and for more specific information on your tax situation, we recommend checking with your accountant or tax professional. And that's all from my desk. We're going to now switch it over to Rachel for a quick Did You Know segment.
In this segment of Did You Know, we would like to announce that our team was recently recognized by the Globe and Mail as top advising team in Alberta. Now, this is excellent news, but we couldn't have done this without our wonderful clients. We're always very thankful to be recognized for doing what we love. Now, in the past, we have received your referrals, and this is the greatest compliment to the Zukiwsky Group. So if you have a friend, a colleague, or a family member who's interested in a complimentary second opinion of their wealth or financial plan, please don't hesitate to send them our way. We'll be back in January to give you our outlook on 2023. And we thank you for watching today. On behalf of the Zook Group, we wish you a safe and wonderful holiday. Take care.